Today's open mic is going to be the Mr. Rogers edition. We're going to talk about my attire, and we're going to talk about Carvana and CarMax as well today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. You'll notice I've got my casual Mr. Rogers sweater attire on today. It's not particularly warm in here. The Bay Area has been a little bit cooler of late than usual, and the heat in this room, in order to get the heat in this room to an appropriate temperature, means other parts of the house are going to be too hot. So I'm going to avoid that and wear a sweater instead. I was thinking about a couple of things today that we might talk about before I get to your questions. The first of these, of course, the Fed FOMC decision came down today. We got a quarter basis point rate cut, which I think we've suggested was most likely on recent live streams. It wasn't overwhelmingly dovish because one of the other things that was said was that they were hinting at maybe another rate cut in 2026. Another one, a single rate cut. There were some dissenters. The vote to cut was 9-3. 25 basis points, as I've previously alluded, I don't think is all that material. And so here we are. I also should point out that, with respect to sort of the issues that we have, the sort of tie-up, the lockup in the housing market, it is not as if a 25 basis point cut or even a 50 basis point rate cut is going to make that much of a difference one way or the other. And the reason that's true is because there are a lot of people who are locked into, they're not locked into mortgages, but they probably perceive themselves as being locked into mortgages because their rates are considerably lower than mortgage rates are today. People in that circumstance do not have a huge incentive to move. This is, by the way, a quick look at the futures. You can see that we'll just take a look at the intraday. I think that's probably the best way to take a look at how this is. So we'll pull that up. Actually, in some ways, I'm kind of surprised, I have to say, that the futures bumped as much as they did because I didn't think that what was reported was all that unexpected, but maybe some were expecting worse news. So here we are, up a little less than 60 basis points. Or maybe it's just taking a little bit of concern from those who thought we might not get a cut away now that we have indeed had one. Okay, so what I was looking at, and you know what, I just realized I don't have, I'm going to have to pull this up. I did not have the comment section in here, so I should pull that up so that I can see what questions are being asked, and we can take a look at that. Let's go back, though, very quickly to the stocks that I wanted to talk about, which is this chart right here. In the chart here in blue, which I will highlight right now, that is Carvana. Carvana's price axis is on the left. And the candlestick chart that's going straight down, which I will try to highlight here if I can. Does it highlight? Maybe it doesn't. In any case, that's the one that's going from the upper left to the lower right. That chart is CarMax. What do these two businesses have in common? Well, they have a decent bit in common. These are both car dealerships. They do a lot of used cars. And CarMax's business has been hard hit. This is a function of a couple of things. It is car affordability. Car affordability is in turn affected by, among other things, interest rates, which we were just talking about. And also car prices, and also the state of consumer finances. So the question one might reasonably ask, well, both of these are national chains. Both of them sell used cars. Both of them presumably serve similar markets. And one has lost about 60% of its value. Is that what that is? Let's take a quick peek. We'll double check. Go from here to there. 55% of its value, and the other has almost doubled over that same time frame. And actually, if we go from here, much more if we go off those lows. Oops, I don't think that picked the right security, so let's just delete that. Not that it matters a whole bunch. I think you guys get the point. Now, this most recent rally, the reason for this is because Carvana is going to be added to the S&P. Unsurprisingly, the nice thing about being a constituent of the S&P is that you get a lot of passive investment into your stock, because every single time somebody buys the S&P 500, they're going to allocate a portion of that to your underlying stock. Now, a couple quick things about it. We owned Carvana stock in one of our discretionary funds previously, and we still own Carvana stock in one of our non-discretionary funds. We have a covered call strategy ETF, ticker CVNY. I think we've got about $62 million worth of Carvana in that thing. And that has obviously done very well of late, a function of the underlying stock's performance, plus the fact that this harvests a decent bit of premium. So we have here the returns of that fund since it was launched on January 30th. If you had reinvested the dividends, this is the number you'd have gotten if you had reinvested the dividends, almost 75%. And if you had simply taken the distributions in cash, your total returns would be 41.2%. And the share price itself is down almost 15%. Just remember that this is because if you take the total amount of distributions, and it had a lot of distributions, you're giving away the call premium when the stock price goes down, and you're giving away the gains when the stock price goes up. It's one of the reasons that the stock price might not do so spectacularly well, even though the fund itself or the performance was very, very good. And in this particular instance, if you had invested in this, you've taken, call it 56% of the initial investment back in distributions. But my thinking is, now we're going to continue to be invested in this because CVNY is a passive fund, so we don't actually have a discretionary view that we take on the underlying stock. But for you viewers, my view on this is that I'm wondering whether we're getting to a point where it might make some sense to not necessarily bet against it just yet, because like I said, there's a lot of passive money flows going into it. But if you have Carvana in your portfolio, and good for you if you did or do, because you've obviously done exceptionally well, the valuations now are getting a little bit hard for me to get my arms around. So let's just take a look at that very quickly. So it's trading 467, which, where's my handy dandy calculator? That works out to, 64 times almost next year's adjusted EPS. And that is quite extraordinary. Something else I think that's important to understand about Carvana is that the way this company makes money is not just by grabbing really big margins in the underpinning cars that they're buying and selling. It's not like they spend much less to buy their inventory and sell it at a much higher price than their competitors do. In fact, there's a lot of evidence that in many instances the opposite is true, that they pay more and sell at a lower price. Where they make their money is in the financing. So if we go to their website, and you might want to take a look at it, I think you will see that they talk about the fact that they can get almost anybody financed. I think 99% is the thing that they advertise. So if you want to buy a used car, you can go on here. Let's see if we can find it. Oh, they've got Shaq out there promoting their activities. Isn't that nice? So you have all of these cars. They do have a an interesting aspect to this, which is that they can just drop the car off. And I believe there's even a period of time, free shipping, get it tomorrow. It's like buying a used car on Amazon. And I think I've previously mentioned that I've used this company myself. When we moved from Texas to California, I sold one of our cars to Carvana and got what I deemed at the time to be a very good price for it. But let's see, go to the financing. We welcome all credit types. Now, the truth is, they may indeed welcome all credit types, 99% approval rate. I think the truth is that many of these outfits actually prefer people whose credit might not be so good. It's not clear to me that dealerships and auto finance companies can make a huge amount of money offering financing to people who don't need it. Because if the terms aren't great, you'll just say no. I have financed cars. I have a financed car even as we speak. But the rate on that car was 0. 0% APR for 60 months. Had that, I don't know, for a couple of years now. So one of the 3 cars we have. And at the time that I purchased it, that was not even the deal that was being offered. The deal that was being offered was 0% for 3 years. 20% down, 0% for 3 years was the deal that was being offered. And I went to the dealership and I said, I'll tell you what, I found the lowest price I could pay for the car at any dealership within 100 miles if I paid cash. So I said, this is how much I'm willing to pay for the vehicle. Then I said, I'd also like to get 0%, but not for 3 years, for 5. And oh, by the way, I'm not going to put anything down. And if you like those terms, then I'll take the car. And if you don't, then I won't. I wasn't in a desperate rush to buy one. We knew we needed another car anyway. And I thought those terms seemed favorable. And they're the ones that brought up this 0% thing anyway. Sure enough, they said, okay, fine, we'll do that. And that was that. Did they make a lot on the financing of the vehicle? I don't think so. I mean, I'm assuming the way that worked, because I believe it was the underwriting bank is a bank I already do business with. I think it was Chase, if I'm not mistaken. But the point I'm making is that Carvana's business depends very heavily on their profits on this part of the business, the financing portion of the business. And the financing portion of the business does not make as much money off of people who don't need it. Because if the price isn't good, they just won't do it. They tend to be a lot more aggressive in terms of their negotiation. Whereas people who buy used cars who are struggling to afford it are more likely to say, well, I can afford to do this. See, notice this. You've got a car right here, this Honda, $395 a month. I mean, it doesn't really give us any additional details, and I'm sure that's just supposed to be representative, but somebody's looking at this saying, I can afford $395 a month. And frankly, in these days, if you have a family with mobile phones, your mobile and your cable bill are probably $395 a month put together, at least seems to be in my household. So you would say, okay, I'll do $395 a month, and they pretty much ignore everything else. And this is especially true of, and I don't know if you guys can see this part here. I'm going to blow this up. Especially true when you have this bit here. All credit situations welcome. I don't know if you can see this. But they're saying all credit situations welcome, get pre-qualified, even with bad credit, no credit, or a past bankruptcy. So the reason I bring all of this up is because when you have that circumstance, at a certain point, you're going to end up in an area where I think we're probably really working with the last of what's available. And that would be fine if the thing was trading 20 times forward earnings, maybe even 40 times. We've got year-on-year growth rate here of anticipated 43%. That might be achievable. But, at 64, 65 times, if any cracks emerge, I have a feeling that we're kind of running out of gas here. I mean, this is a business that is now $100 billion. It's a lot. It's a lot for a used car dealer. So, solutions, if you own it, especially if you're in a high tax jurisdiction, maybe selling it's not so appealing. I get that. Because if you've encountered all of this rapid appreciation, especially if you've only held it for a short period of time, it could be a short-term capital gain, not so attractive to look to sell it necessarily. But you can contemplate selling covered calls against it or something like this, or even what we did. So what have we been doing? We've been selling covered call spreads against Carvana. And we were selling covered call spreads even going into this event because all the things that we think are true now were also true then. It was being added to the index and all that. And we were still able to capture a significant portion of the upside. Not as much as we might have had we not sold any upside premium, but a material portion as the returns illustrate. Since the beginning of the year, up 70% or something. And that's selling premium against it the whole way. So what might something like that look like? I'll just give a quick example, and then we're going to move on to some other ideas. So we're going to actually, and this is interesting. So technically, the options play application is bearish on Carvana now, but since we're talking about, another thing, you can sell upside call spreads if you're going to take a bearish point of view without owning the underlying, because it is a defined risk strategy. So we can take a look at this. Probably wouldn't go out this far on the short side. And we can just invert this. You could pick something that's at or even just in or slightly out of the money, depending on your preference, how bearish, if you are bearish, you want to be. And, sell something like this against the, against the stock. Like this. So you get a standstill rate of return in the event that the stock just goes sideways from here. You get some profits. This is kind of functionally equivalent to being long a put spread. This would be actually synthetically equivalent to being long an in-the-money put spread. The difference between an out-of-the-money spread, which would be a debit vertical, and an in-the-money one is that in one case, time is working for you, and in the other, it's working against you. So in other words, you put this on and the stock just goes sideways, you'll collect your money. If you put on a debit spread and the stock goes sideways, you'll end up losing whatever debit you paid. So squeezing the balloon, you increase the probability of profit. You get a standstill rate of return. That's the positive. The downside is that a put spread's probably going to trade at, call it 25% of the distance between the strikes to make your bearish bet, and so the payoff will be higher, but the probability will be lower. Okay, so let's see. FinWest, by the way, got your message about the office hours audio issues. Really interesting that you happen to mention that because we were all talking about it right after yesterday's show. What is Mark's microphone situation versus... You can see mine's actually right in my face right now. But yeah, we're going to check those levels so that hopefully when we have guests, it's all going at approximately the same volumes. Okay, so good morning, Mike. Do you have an exit price for the short strangle in Amazon for Jan 26 you discussed? I'm in at 520, now 275. I often use a 50% profit, thanks. I think that's a good standard. One of the things I have pointed out is that, and maybe somebody can remind me exactly which strikes we were talking about in the one that you were referring to, because I actually didn't book it into the options play portfolio, so I can go back and reference it. my general approach is that when you're short an option, I'm always comparing that to both the risk-free rate. So that's going to be the amount of premium that I'm collecting relative to the strike over the amount of remaining time. So what is that standstill rate of that short option? Because there can be circumstances where you might say sell a strangle and the stock gravitates towards one of the short legs and away from the other, and you have an opportunity to close one of them at, a very low amount of premium, and certainly an amount of premium that doesn't stand up on its own as an attractive amount to get paid for being short optionality. So that's the first thing I would take a look at. But 50% is fine. January is still a bit away from where we are right now. So to have made a 50% profit in a relatively short period, I think it certainly makes sense. You can take profits for sure on that. But if you are collecting an amount of premium on a short option that is anywhere close to the risk-free rate relative to the strike between now and expiration, take that off. That's sort of my basic rule of thumb. And as the stocks float around in something like a short strangle, unless it lands dead in the middle, there's a good chance that you're going to end up taking off one of those legs before you take off the other, using that as your guideline. So I hope that helps. Jim Howard, hi Mike. Despite their capital cost per vehicle, to what extent do you think Waymo is going to pressure Uber and Lyft in 2026? Much of an impact to Google. So I don't anticipate a huge impact to Google in financial terms on their financial statements. But let's just take a look at why that is. So let's look at Lyft first. Lyft obviously is very well known, and they have a decent business. That business is growing at a decent rate. It's trading at a not ludicrous multiple. We can see here you got a $7.5 billion business. It's going to have $1 billion worth of free cash flow, so that's quite a handsome free cash flow yield. $20 stock, $1.50 a share in round numbers. So it's trading just 13 times forward earnings. But the real thing I want you to pay attention to here is the revenues and net income numbers. So let's imagine that in 2026, Waymo was as big as Lyft is now. Right? So as common and basically as prolific as Lyft is, that Waymo will be that for Alphabet in 2026. Well, what would that mean? So let's just use these numbers, and then we're going to map it and say, okay, well, that'd be $7.4 billion in revenues. This would be $700 million in EBITDA. It would be $600 million in net income. Well, I probably don't need to show you the table I'm about to show you, but even before I do, you can probably guess where I'm going with this. And that is that in terms of the financials of Alphabet, that's utterly immaterial, right? Because in full year 2026, Alphabet's going to do $390 billion worth of revenue, $140 billion worth of adjusted net income. $600 million in incremental net income is indeed a rounding error. It is way less than 1%. In fact, it is less than 0.5% of their adjusted net income. That's if Waymo is the same size as Lyft. But does that mean that's how much it adds to its enterprise value? In other words, let's just say for the sake of argument that Waymo did all of that. That they were going to get, let's say they did $600 million in net income in 2026. Lyft trades at 13.3 times. Does that mean it's going to add $7 billion to the $3.8 trillion enterprise value of Alphabet? No, it doesn't. Because Waymo, what makes Waymo more valuable is the fact that it is a technology business. We're talking about self-driving cars. This is a very different thing in terms of its scale and scope than the business that Lyft has. And in fact, as you look at the valuation of Lyft, Lyft is trading at 13.3 times adjusted forward earnings on decent growth and solid free cash flow because of the threats of things like Waymo and because of the threats of things like full self-driving from Tesla. In other words, the real question is, where do they live? Where is Lyft and Uber in a world where cars drive themselves. And that's, that's really the issue. So I have often thought that Alphabet didn't get enough credit for Waymo. I also felt like they weren't getting, for a while, I thought they weren't getting enough credit for AI. I've said that all year long. I was certainly saying it at the beginning of the year. I don't think that's true anymore. I think they are definitely getting credit for it. I mean, the thing's trading 30 times earnings. That's 10 turns richer than it was a year ago. So they are getting credit for it now. So when I look at this, I think of it more as a threat to those other businesses than I think of the value of those other businesses incrementally to Alphabet, because they are just, I mean, it seems crazy. I mean, Uber is not a small business. It's much bigger than Lyft. It's not a small business. $180 billion. But even a $180 billion business is still quite small. Big as that is, that's still quite small relative to a $3.8 trillion company, which is what Alphabet is. And I could very easily see Waymo overtaking Lyft. And it isn't hard for me to imagine that it overtakes Uber as well. Now it's interesting because in some ways I'm kind of surprised it hasn't grown bigger and faster. Now that the cost per vehicle is quite high. So Jim, I don't know if you are in an area where Waymos operate. I am, so I see these things all the time. I deal with them in traffic whenever I'm driving in the city here. These cars, if you haven't seen one, I encourage you to Google it, take a look. This is not like a car, like a Tesla with full self-driving. I mean, these things have sensors and spinning things on the roof. They're complex vehicles, and I can imagine that they are very expensive. I imagine those costs are going to come down. And I also imagine that, ultimately, although the capital cost on those cars is quite high, I would hope that they last a decently long time. You don't have, if you imagine, go back to the 1980s and imagine hopping into a New York City taxi cab and how the average cab driver treated the car they were driving. Periodically you'd get into an owner-operator, but very rarely. They beat the hell out of those things. If you watch a Waymo drive, you're going to notice these things are cautious. They don't accelerate or brake particularly hard. So my guess is that the lifespan, at least for a commercial vehicle that carries paying passengers, that the lifespan should be pretty good. And I would hope that some of the sensors and other parts of those things might be reusable, and that also the cost of them as they start to proliferate is going to come down, perhaps geometrically. I very much think that Waymo has a big part of the self-driving car future. So I would say that. And I still like Alphabet. Broadcom has rallied significantly into earnings, which are tomorrow post-close. Thoughts on a trade setup, either pre or post? We own it. How much do we have here? Let's see what we have on it. Oops, sorry. So, we have 183,000 shares. And we are basically in a collared position with a short call spread in it. Now, bear in mind that I have often said that I'm not super enamored of getting short a lot of premium just going into events. This is kind of our mandate, though, because remember, we're supposed to have a positive carry in our funds. It's in the name of what we do. So we're generally going to be short more options than we're long. But we are long some in this case. In fact, what's interesting is that we're actually, although we have positive carry, we are long more options than we're short because we're long downside tail risk hedges and we're short call spreads. So what does something like that look like? We'll construct it here. And since we're long the stock, I'm just going to begin by saying, okay, well, we're long stock because we are. As you saw, we've been long it for a while. We have, as I pointed out, 183,000 shares. So it's actually, at the current stock price, that's a pretty good chunk, actually. So about $75.6 million of it. So we are buying downside puts. These are tail risk hedges, like in case something really disastrous happens, and short upside call spreads. So we own a downside put, and we're short a call spread. And see which ones I should be more specific. So as I go through this, just bear in mind that we tend to trade very short dated. These require a lot more trade management than perhaps some of you watching might be interested in. So we've got the 325s. That is a tail risk. And just put ABGO in here. Oh, actually, we just got the short 405s. I don't know where's normally we would be selling a call spread. So we basically just have a collared stock position on, which is also synthetically just a long in the money call spread would be another way to think about it. 325, 405. Oh, that must be stale because I have to check the filing. That's probably updated. Yeah, that must be stale. So, but normally our position would be short a call spread and long a put. I'd have to check the trade files because that does not look like that updated, because that would be rather unusual to be short in the money calls and long out of the money puts. But it might look a little something like this. So I'll build this trade out. Sell for, is that right? 36. So these would actually be the short side. Probably going to look a little bit like this, and then a tail risk. And let's see what the implied move is in the historicals. I think this is going to be helpful to have some perspective as well. Implying a 6.5% move, average 5.5%, but you can see right in here, this is the relevant section. More recent results have been more pronounced. And actually it's interesting because, of course, one of the reasons that the stock has rallied so much of late is because of their collaboration on the TPU, which has been designed by Alphabet, which we were just talking about. So, and as you know, we own both of these stocks. I think this is a fairly important collaboration, it should be said. And I expect them to say positive things about it. So, let's see here. If I'm going to assume, a really bad potential outcome, what would that potentially look like? Like a 380 type of thing to the downside. Get a little something like that. So if they really blow the doors off, so you end up with this, end up with something that looks like this. Looks like kind of a long in-the-money call spread with a kicker on the top. And that basically trades for approximately even. This is going out to January. Ours are more short-dated. But that's, the kind of thing that one might potentially contemplate. And actually, I would even go so far as to say that I might consider, because my biggest concern on the tail risk side is that we just get a nasty surprise coming out tomorrow. I don't really need this protection. This is really an event risk type of an issue. I can potentially, push this short put side. I mean, the long put side, into a shorter dated expiration, just to create a short tail, and that's going to give me a little bit more immediate protection at substantially lower cost. So that might be one way I would thinking about doing that. Eileen, just wondering your thoughts on Disney right now. This is an interesting time for Disney, partially because of what's going on elsewhere. I mean, we've got this bidding war, which, Eileen, I think it was you who had referenced or asked about, with Ellison and Paramount and Netflix and Warner Brothers all, in the fray right here. It's funny, we've got these record-breaking breakup arrangements, breakup fees, and it's kind of interesting to me that, Warner Brothers had this $5 billion breakup fee, and Netflix gets 2.8 in the event that it goes to Paramount, which, look, I mean, not bad work if you can get it. And one almost wonders, is that a terrible outcome for Netflix? If they fall into the hands of Paramount, so they get a $2.8 billion payout, and they may possibly have faced antitrust concerns anyway. That's one possibility. I think that the combined company of Netflix and Warner Brothers, I had kind of better hopes for that as a concern. Couple of reasons for this. Number one, Netflix is clearly a great operator. They're the leader in the space. The other thing is that, and I didn't mention this when we talked about it, and I should have, is that the Netflix arrangement was not that they were going to get all of Warner Brothers, right? So there were certain key portions of that business that they were interested in, whereas the Paramount deal is like an all-encompassing, one-and-done kind of an arrangement. I think it is better for Disney if Warner Brothers and Paramount came together than it is for Netflix and Warner Brothers. My 2 cents on the entertainment side. Let's just take a look at some other aspects of their business, though, while we're at it, and their valuations and things like this. The real reason to own this company for the longest time, up until about mid-2015, was their almost metronomic sort of earnings and revenue growth, 40% of which was part of that ESPN thing. Because ESPN was must-see television. They sort of commanded the whole space, and that was a great thing. That's no longer true, so they commanded a huge premium as a result. But, take a look at it now. We've got decent, respectable growth. This growth number here means it's not showing up on my screens. By the way, I only accidentally switched this thing to yellow, this annotation tool. I think it actually looks a little bit better. That's a little clearer, so I kind of like that. So in terms of valuation versus their earnings next year, certainly not bad. We're looking at less than 15 times forward with an 11% anticipated growth rate, 5% free cash flow yield in round numbers. I'm calling it $10 billion versus $200 billion market cap. As you guys know, I find it not that useful to split hairs on these kinds of things. So I think that's solid. Again, does it meet my screens? Their growth rate isn't at the level where I would say, okay, on top of a passive investment in U.S. equities, that this is one of the things that's going to rise to the top. Who was I talking? I was talking to somebody earlier this week, and one of the things that we were talking about was another reason why it is that I tend to focus on individual long stock picking in names that are growing at a rate faster than the index is at a valuation I view to be reasonable. And I think it was Mark Guthner, actually, and he said, they found that some of the best performing accounts, I think it might have been at Fidelity that had done this study, were accounts that were held by people who had died and people had forgotten about. And the reason was because they never traded out of the underlying securities. Well, that's going to outperform in what circumstance? That's going to outperform if the stocks you selected are growing and growing at least as fast as the market is. And so that's one of the reasons why I emphasize that if you bought a stock and you just forgot about it, what kind of a stock would you hope to, open up the mail and say, hey, you have a brokerage account that you forgot about back in 2010. And it has 10 stocks in it. Now, I'll just ask you to say to yourself, what stocks do you hope they were? Not based on what the prices of the stocks are now. So you could easily say, oh, well, I want NVIDIA, I want Broadcom, because you know that those companies their stock prices have exploded. But I instead told you that I'm going to tell you characteristics that those stocks that you bought into that fund could have. And I'm going to tell you that you could have bought 10 stocks that had growth rates like this, that have been, over the course of the last 5 years, as low as 2.8% and as high as 6.7%, and probably averaged about 3.9 to 4%. Or, you could just pick from a random group of stocks, like throw darts at a board of stocks that were growing consistently on a trailing 3 and a forward 2 basis of, call it 10 or 15 or 20%. Which basket of stocks would you choose? And I think the answer is pretty clear, right? You would say, well, yeah, I mean, if it was 15 years ago, I'd want to pick higher paying stocks. Well, the question is, what are you investing for? Next week, next month, or the next decade? And, I think when you think about it in this way, it tends to sort of help us think about things and say, yeah, you know what? That's great. Trades 14, 15 times. But if I've got a long time horizon, I think I'm going to look for something that's growing faster than the economy, thanks. And, hope that turns out well and just monitor that business. But in this case, this is a respectable business. It has been around for a long time. It has generally been well managed. It has solid free cash flow. It is growing the bottom line at a respectable pace, at least last 12 months. This year's EPS growth looks pretty decent in next year. So, yeah, it's fine. I mean, I think and it is trading at a discount to the S&P. So if you said, well, I'm going to pull $100 out of S&P and I'm going to put it into this, dollar for dollar, just because I like this at 13.5 times better than I like the S&P at 23 times, if we'll call it that, I'm okay with that. I think it's reasonable. Okay. With AI the hot topic of the year, easily. What do you think of the power to run the AI? Something like POW, POW ETF from Vista Shares. Well, let's take a look at what's in POW. I have liked Vistra Energy, for example, and several other names. Constellation, that's in here. So PG&E, I'm a little less enamored of this one, but that's mostly just because they have a lot of liabilities and things like that. But this is a relatively small portion. Look, I mean, the demand is there. I like the utility trade. Tends to be lower beta. I'm not so sure it's lower beta now. Let's take a look at the Vista Electrification Super Cycle. Fund invest at least 80% of the fund's net asset in a portfolio of global electrification companies. Let's go back to this for a second and take a look at these stocks. Okay. We have a good number of utilities in there, which makes me wonder how that list of stocks compares to this list of stocks. We've got NextEra, we've got Vistra, we've got Constellation. We have a yield in here of almost 3%. I'm going to guess that this one does not have that. Why does this have no yield? That doesn't make sense. It should. I mean, don't they have... I better look at the prospectus for this thing. Why does POW not have any dividend at all? Am I not looking at that correctly? That seems strange. All aiming for capital growth. That's interesting. I mean, yeah, it doesn't have that much of a history to it. I guess the question I would have, look, if you have a lot of faith in the manager's ability to pick the best way to play the space, I think that's fine. They've got a lot of stuff in here. 55 stocks, something like that. But I look at this list and I'm not overwhelmed. I mean, American Superconductor, I guess. Imagine this. Let me just offer a thought. It's a little thought balloon we'll throw out there. A significant portion of these companies are utility businesses. And you can get those, you would get those in XLU, which pays a dividend, okay? So, again, no real complicated situation with that. But, it's that's one of the things you want to think about. And this is on one of our platforms, by the way. So, Title Financial Group is they provide a platform for managers. So I was just looking to see who the manager was. And the manager here is Kiao Duan, it looks like. So this thing is new. And he may indeed be very good and effective at choosing these stocks. And if that's your belief, that's fine. But let me just offer an idea. And the idea is this. If you owned XLU in any decent amount, so this one does pay a dividend, and it has a lot of stocks in common with the other fund. And on top of all of that, it's got an expense ratio of 8 basis points, which is 0 for all intents and purposes. Now, you're kicking off these dividends. You could use those dividends and, periodically perhaps buy call options on some of those other more levered plays. You'll have exposure to the stocks. You have distributions if you want them. And if you want leverage to some of those other names, maybe you could do things like call spread riskies, using some of the dividend income you get off of XLU to do it. I guess it depends. If you're watching this live stream, there's a decent chance that you are taking a more active role in your own investments than many people do. And if that's true, then you might think about how you can create the portfolio that achieves similar results, either with a more tailored experience or arguably lower fees. And if we'll call it fun, I personally find it to be an intellectually stimulating exercise to think about how do I create the aspects of this investment that I like and strip out some of the things I like a little bit less, or leverage some of the things that I have access to. It's just something to think about. I don't have any problem with it. If you have a lot of faith in that manager, it's not very concentrated. One of the guys I used to work with, who I think is a really smart trader, really smart investor, he has not managed other people's assets beyond his own since 2008. So for 17 years, he's only traded his own money with tremendous success, it should be said. And I have many, many times said to him, why are you not getting it back into the business? Start up a fund and get back into it. One of the reasons is he just doesn't like the dealing with anything but the trading. And, the fund management business always has some of that. And he doesn't care for it. He's not interested in it. He said, I would contemplate it. He said, but I would run a best ideas fund. And what he was suggesting is, he said, if you're going to a manager, and they've got 100 names in their portfolio. Is it because they really are experts in all of those and they have high levels of conviction in all of those? He said, if you're coming to me for my best ideas, then it should probably be traded the way he trades his own money, which is, at any given time, he's really got 10 core holdings. I'm sure he has a lot of other stuff too. He's now got a family foundation, got other things going on, but you're looking for people's best ideas. And so the only sort of knock I would offer in this particular case is say, is this a best ideas or is just anything and everything you can think of? Now, the good news about a structure like this, for what it's worth, so I'll speak in this guy's defense, not knowing him, is that there are some names in here that I don't recognize. Little Fuse. I don't know what Little Fuse is. We should probably take a look at Little Fuse. Let's just see what kind of a company this is. So if this is like a low revenue, more speculative type of thing, then, oops, where is that? Let's see what we got. What is this business? They sell in Little Fuse. Oh, they make fuses. How about that? And it looks like it's a relatively mature business. But I'm sure there's some newer, sort of more speculative businesses. And if you are investing in a number of companies that are, stable, like some of these utilities. So it's interesting. If they're not paying dividends, so he's collecting the dividends that all of those pay, and I guess he's just redeploying those into other stocks. So, yeah, I mean, I don't take issue with it. I think that's fine. But, just know what you're getting. 75 basis points. So, yeah. Okay, so yeah, I think, like I said, I don't know if that's helpful. I hadn't really looked at it. I mean, what are we doing? We're looking at it together and trying to figure it out together. But those are just my initial thoughts. Matt McDonald, hi Mike. Goldman is on a recent tear and well into all-time highs. I'm short strangled 800 920 and wondering if I should worry, cover, adjust. Any thoughts? Let's take a look at what's coming up on the horizon for these guys. Well, first of all, let's take a look at how they stand on a relative basis to their in terms of valuation. So this chart, for those of you guys who are not familiar, this is showing where the stock is in terms of its valuation relative to its 2-year history. Let's blow it out to 5 years. And it's probably going to be very similar. So not only is the stock at all-time highs, it's basically at super high valuations on a relative basis. So it's trading at 2.4 times price to book. And what's interesting here is we've got a couple names in here that are trading at a premium, but I wouldn't necessarily put all of these in the same bucket. Evercore, no. Piper Sandler, no. Not the same basket. Lazard, much less trading, more of an advisory outfit. Nomura, no. And even Morgan Stanley is not quite the same as Goldman. Morgan Stanley and Goldman used to, they were very much in the same business. The two preeminent investment banks, one could argue. Sort of the two preeminent white shoe investment banks. Morgan Stanley has, as almost everybody watching probably knows, as a company, they have pivoted much more significantly than Goldman has towards asset management. Goldman very much remains a trading house, very much remains an investment banking house. And so their businesses are a little bit different in that respect. When I look at Morgan, I think of a business where their fees are going to basically move in tandem with asset prices generally. Those things generally rise. They are, net accumulators of assets under management. So that's a very nice business. Goldman is also a very nice business, but it is somewhat different because more of the money that they make comes from their trading profits, and their trading profits are significant, and they are also they come in quite regularly. It's always amusing to read the financial statements when these guys report at the end of the year, and you see, okay, they will talk about their trading profits, and then they'll talk about how many days they made money versus lost money. And it is not uncommon for them to report that, we lost money 5 days in the last quarter. Honestly, they just don't lose. Market making is a very good business in that respect because you have the tailwind of, buying on the bid and selling on the offer. They're just very well positioned. And when you're doing this, not for little odd lots of stock, but for bigger blocks, then they tend to make money sort of with the same kind of regularity that the old specialists on the big board typically would. Pretty good business. But the valuation is getting up there, at least compared to the company's own history. You mentioned that you are short the 809.20. What expiry? Jan 9th. Oh. Well, you're still right in there. I mean, that's not a bad spot. Okay. Still generally bullish, and that's the trend we're in. So let's go out. January 9th. That's going to be over here. And you've got the 920s, so that's right here. So that's basically the level that you're talking about. Right there. Well, I'm imagining, by the way, those 800 puts, those can't be worth very much, right? So those are probably getting close to time to cover territory, I'm thinking. Let's take a look. Oh, this is after the close. Let's see where these things were a little bit beforehand. So let's take a look at where these were 15 minutes before the close. Oh, they were pretty wide. That's wider than I would have expected. Let's imagine you could get those off 3.5, 5, 75, 425. Let's imagine you can get those off at like 425. That's over 800. So those are 53 basis points of the strike. And those expire. You're getting close on those ones. Remember the rule that I was just talking about a little bit earlier. So you have 30 days to go. That's 53 basis points. So that's 6% annualized. Risk-free rate's probably, 375 or thereabouts. So that means that you would cover these suckers. If they lost, within the next couple of days, if these things come in, another $1.50 or so, you would cover these anyhow because the amount of premium that you're collecting on those is not that is not a lot as a percentage of the strike, right? So what am I doing? I'm taking the premium, I'm dividing by the strike, sort of calculating that as like a crude measure of the amount of money that I'm making relative to the risk I'm taking. And is it really the risk you're taking? Is Goldman Sachs going to go to zero by January 9th? No, it's not. But you sort of get my point, that's essentially where if you were put the stock, you would own it. So do you want to take, that kind of risk? So, I can then compare that to the risk-free rate for a comparable period of time. How much time I have to go until expiration, and then I might potentially look to cover that. On the call side, meanwhile, which you have the 920s, Those things are still going to have a meaningful amount of premium in them. And the upside break even there is 935. And so, our next question is, well, are we likely to encounter much resistance up at around that level? This does look also like it's pretty extended above the 50 on a relative basis. Let's see here. So how far above did we get here? So I'm looking here. Got pretty far above the 50 here. We did. Here we did. And here we have. I think I would be all right with this. I would probably, the one thing I can say is that, something you might consider is if you start to feel a little bit uncomfortable, you can do a little bit of delta hedging. And what do I mean by that? If you sold this thing and it was a 20 delta option, and now it's obviously much, much higher. Let's take a look. One thing you can consider is buying a little bit of stock just to mitigate it if you're getting concerned. You don't trade it one up. You don't trade it delta neutral because you were short the call to begin with, and maybe you were short. Maybe you were comfortable being short 20 some odd deltas, but you could buy 22 shares of stock for each call you're short, and just say, look, I'm comfortable being short 20 deltas. I'm not comfortable getting short 47 deltas. Actually, these were not the 900s. Sorry, you were the 920s. So maybe in this case, I'm comfortable being short 20 deltas on the call side. You could buy 14 shares for every call you're short. It's not a lot, right? And just what that's going to do is it's just going to mute the impact in the event that it runs to or through that strike, because it is close, right? There's is it better than not chance you get away with this one, but one chance in 3 that you don't. So you could buy a little bit of stock to mitigate it. It's probably how I would look at it. But it does look like it's getting a little extended above the 50, doesn't it? We haven't had much of a pullback. I mean, I think the market's going to do fine through the end of the year, but it's maybe a little frothy. So I wouldn't be uncomfortable with that. If I had that position on, that's probably how I would handle it. I'd start to look to cover that short put, and that short put has a little bit of long delta to it, so the delta of my aggregate position now will actually have gotten shorter when I cover that put, and I would probably buy a little bit of stock to cover. So, market sold off Netflix already. If the deal does not go through, is that positive to Netflix? Will Netflix rally back to 100 plus in that case? If the deal does go through, Netflix thinks it's good for them. I like Netflix. I have said, I hate using the same expressions all the time, but unregulated utility, best of breed, reasonably valued relative to growth. All of those things, I think, remain true. Here's the thing. So if they don't win the bidding war, does that mean that Netflix is right back where they started from? Well, no, not exactly. Because if they don't win the bidding war, that implies that Paramount did. That means that Paramount and Warner Brothers are going to be together, and that means that Netflix doesn't have to contend with Disney and Amazon Prime and Warner Brothers and Paramount. It has to contend with Amazon Prime, and it has to contend with a Paramount Warner Brothers duo in one. And my guess is that is a more powerful adversary than the two are separately. So the landscape is not identical in a world where Netflix is contending with that entity merged as it did contending with the two businesses independently. However, the upside is that they're going to get $2.8 billion. Is that a lot? It's not a huge amount. 20% of next year's adjusted net income that they're going to collect. That's a positive. But they still have remarkably good free cash flow. They are still growing the top line. They are still the best of breed. And they're trading cheaper than they were. The biggest problem for me, and the reason that I am not reaching out to get it right now, is because it actually doesn't meet my screens. And what screens are those? It's this. You know what they say, nothing good happens below the long-term moving average. It's below the 200. And I do happen to screen on that, right? And is that because I think it's a hard and fast rule? If you happen to own it, I'm saying it's below the 200, therefore you sell it. I'm not saying that. But what I am saying is that every single day, you guys have seen me go through it. I go through the same process where I'm saying, what might we buy today? And I have to throw a lot of stuff into the bin. And actually, the CIO, he has a special carve out in the way he thinks about things like this, which is, he calls it special sits. In truth, in terms of trading, special sits is usually corporate actions would fall into that category, risk arb, things like this. But in our context, what it really means is that, we have a general rule about this is the kind of stuff we're looking to invest in, and these are the stocks we're going to look at. And then we have a little carve out like, okay, we're going to make exceptions in these cases. Netflix certainly is in the contender pool for names where I would make an exception to the early rule because I think that it's worth a gander. But the truth is, I have a feeling that this stock actually, where would I really get compelled is I would say, okay, I like this one fundamentally. It's below the 200. Really broke out from these levels before we got into this whole thing. So if we got back into this neighborhood, I would say, okay, I really think we ought to kick the tires in here. Just looking for, the possibility that could be the end of this little swoon. And incidentally, you're going to notice that that's not even, think about this, you would then have the opportunity with the benefit of 3 years of history to potentially acquire Netflix at only a nominal premium to its late 2021 peak. That would be only $10 higher than it was then. If you hold the company, though, I'm perfectly happy with it. I would probably just be selling a little bit of premium on both sides. But, it's very reasonably valued where they are right now. For Amazon short strangle, the 205, 255s. Right. Let's just get back to that chart. We'll do the same thing here now for Amazon. So we're looking at 205, 255. Right like that. That's sweet, man. Right where it should be. Doing exactly what we like. But, to your point, it was up 50%. And so now the premium on those things, remember, if you just look at the risk-free rate relative to the strikes, and as soon as you get to that point, then I would look to push to roll out. That's how I would think about it. Because there is that sweet spot. I drew this chart before where you look at the theta curve relative to time and it goes like this and then it falls off, right? And it's falling off not because they're not decaying at a high rate relative to their own value. It's just that their own value has become de minimis relative to the price of the stock. And that's another way of thinking about that risk-free rate as sort of a barometer to cut things off. But right now you're in the sweet spot. But yeah, I think 50%, maybe 60%. I haven't heard. I don't know that I've ever said 50%, but certainly 60% is a threshold where I have previously discussed as an opportunity to say, yeah, it's a decent time to roll. Bearing in mind, you want to keep an eye out on catalysts. The self-driving cars of Waymo got into an accident in San Francisco a few days ago, and 3 of them blocked the street. One Waymo hit another, and a third Waymo appeared to be rubbernecking. Yeah, Waymo's had 2. I don't know. Maybe are you able to show? Producer's in my ear. He's looking at the video. Yeah, let me do this. Yeah, there is a video here of it. So they've had a couple issues with accidents. This is one of those issues. But they've had others. So they killed a cat a little while ago. And that was big publicity, like some famous neighborhood cat. Then they had a situation where they killed a dog. Not that long. I mean, dogs and cats get killed by cars in accidents every single day. But if one gets hit by a Waymo, it's much bigger news. I had I didn't have a friend. I have a friend who currently works for GM. He previously worked for Cruise. And Cruise had an accident here in San Francisco, and it made a lot of publicity because somebody was running across the street. They got tagged by a car being driven by a human. That person then got thrown in front of a Cruise that was self-driving coming in the other direction. That car tried to stop but failed because it literally got thrown right in the path of the car. Car hit the brakes, and then it stopped, but it stopped on top of the person. The person lived. So let's start with that. Fortunately, the person lived. But when self-driving cars get into accidents, it is much more, a lot more negative publicity for them. So I've got this thing playing right now. I don't know if you can see this. You'll be able to look this up yourself. But this is 3 Waymos. I mean, this really looks like the beginning of a joke. 3 Waymos go into a bar. 3 Waymos meet on a hilly San Francisco street. I don't know what is going on here. That looks like a little bit of a mess. Yeah, so those two are touching, so they obviously crashed into one another. And the third one is sitting here. I don't know. I mean, if you drive in the city these days, you're gonna see all kinds of crazy stuff, and not just from Waymos. But I can pretty easily see how this particular I mean, how the heck did that even happen? That one of them looks like it was coming out of a driveway. Anyway, I mean, Waymo adds a lot more value to Alphabet than the value of Lyft. And probably, I don't know if it adds more to the value of Alphabet than the value of Uber, but certainly way more than Lyft. Because despite instances like this, this is the future. It absolutely is the future. And, right now we've got FSD on one of the cars that's parked in the driveway. Not my car, it's my wife's. She won't use it, but I think it's phenomenal. I love it. And I love it even knowing I don't trust it for everything. But once it gets to that point, wow. What a convenient thing that's going to be. I would just... Okay, so it looks like I have chewed up an hour and 15 minutes of your time, or thereabouts, and the producers have other things that, other programming things that they have to get to. So unfortunately, we're going to have to cut it off here. But subscribe, keep the comments coming. 996 Capital Fund with your questions about copper. I will address that. And in fact, maybe I'll write an article about that and I'll put that up onto the site. But in any case, thank you all very much for watching, and we'll see you back here real soon. Thanks for watching.